Okay, whenever we get into making an investment, we always want to measure risks and rewards. Now, risk can come in many shapes and forms, so we want to at least address all the risks uh, that are knowable before we enter into an investment. So, one of the risk, of course, is financial, and that risk could be what we're anticipating could happen in an investment could be greatly different than what actually happens. So many times when I enter into investment, whatever I put in, if I put in $1,000, I assume $1,000 worth of financial risk. And I'd have to assume more if I borrowed in order to make the investment. But if you invest in cash, what you put in is the maximum amount you can lose. Now, as we invest, there's individual stock risk. The whole market could be going in one direction, and the one stock that you picked could end up going in a different direction. So we can avoid some of that risk by going into an ETF, although we actually miss upside risk by spreading out our risk. So individual stock names are good to be involved in, but we really need to do our homework on it. We really need to believe in the company as well and hope that they're reporting the right information. So stock risk can be mitigated through an ETF or a mutual fund, but of course you limit your upside by spreading out the risk that way. Now, industry risk. Now, the industry you could be in just could be struggling at the moment. So right now, you could be in a very good stock, but the industry, let's say fossil fuels, is has been in steady decline. Uh, Oil prices have been hurting them. So, um, well, pretty much every industry is getting hit right now. We want to look for an industry that is doing better than the market and avoid industries that are struggling right now or having trouble reinventing themselves in a changing market. Now, political risk is always an interesting one. So there's areas of the economy we always want to check around an election day, because you can see with the passing of a law or the electing of an official, certain parts of the economy might do better than others. So political risk is always something that you should have on your horizon. Now, inflation risk. Inflation risk is something that we need to monitor as far as some investments which are labeled risk free are not risk free from inflation. Now, that inflation risk is the amount of the investment that you will lose based off the eroding purchasing power of the dollar compared to other currencies and hard assets. So, if we were making 2% on an investment, but inflation is going at 3%, we're actually having a negative return. So that's even though we have more money in our account at the end of the year, that money buys less. Okay, so now with risk comes shocks to the system, and I think we're experiencing some right now. So the three types of shocks that we have or we could face are demand shocks, and demand could be for any reason. Many times this is confidence driven, but people just decide we're not confident about the future, so we're going to stop buying something. And when the demand drops, the price drops precipitously. Okay, you can have a positive shock where everybody rushes out to buy something and the price is going to go through the roof, or a negative demand shock where people stop purchasing things altogether, or companies or governments stop purchasing one item altogether, and you're going to see a huge decrease in price. Supply shocks can happen, and that's a sudden event that increases or decreases the supply of a commodity. So if we see right now, uh, Russia and Saudi Arabia are going back and forth on oil prices. Okay, and I believe I read the other day somebody else entered the fray. But they put so much supply onto the market that the price of oil is dropping precipitously. So, too much supply, the price is going to go down. Too little supply, and the price will go up. As we can see right now in the price of toilet paper, as the supply is gone, the price that you can find online or price gouging is extremely high. That's partly a demand shock as well as a supply shock as well. Now, financial shock. This is a sudden event that originates from the financial sector. This could be banks have lent out too much money, and there's no liquidity. There's no money left in the banking system. The stock market could crash, or you could have a currency devaluation, among others. You could have a change in monetary policy. Like right now, the Fed is really trying to change the monetary policy to help things out. If they do something suddenly that the market didn't anticipate, you could see a shock to the financial system and a loss in confidence, either investor or consumer. Okay, so we're going to have a Google form that's going to be posted in a little bit that's going to test some of the videos that you've watched during the week. Once again, I apologize for this format of trying to get content out this way, but we're doing our best. I hope you guys are all well at home. All right, stay strong. We'll see you again soon.